Hello everyone, I'm Ethan and I'm going to talk about Woolworths Group. Woolworths is a supermarket chain and is the largest retailer in Australia with over 190,000 employees and 1,000 locations. Woolworths is part of the supermarkets and grocery stores industry. This industry boasted $130 billion of revenue last year alongside $5.5 billion in profit with a 4% margin. Woolworths have a strong market position in this industry with a market share of 37% with major competitor Coles having 27%. Woolworths have a market cap of $45 billion and a current share price of $37. The 52-week low is 31 and the high is 39. The current dividend is 2.6% and the price to earnings ratio is 27. Return on equity is 27% and return on assets is 7%. Overall, the company is financially healthy with a 65% debt to equity ratio and strong balance sheet. The most significant strength of Woolworths is their brand image, which has strong penetration and is positioned as fresh, familial, and a supporter of the community. Woolworths have committed large resources towards their brand image in the form of marketing sunk costs, which act as a barrier to entry. This is because sunk costs represent a large investment in intangible assets, with many potential players unable to match the sunk costs of Woolworths. Given their success, Woolworths doesn't have an abundance of weaknesses. However, they have received media scrutiny over underpaying employees, which is detrimental to their community-focused brand image. The biggest opportunity for Woolworths is the consumer trend of convenience and online culture, which is being accelerated by COVID-19. Consumers are placing higher value on convenience, which has increased the proportion of online sales. Woolworths have large long-term assets such as available land, so they're able to quickly build the required infrastructure to take advantage of this emerging trend. A threat to Woolworths is the behavioural response of Australian consumers to the price war with Coles. Consumers have become increasingly price sensitive to supermarket products due to the expectation of incoming sales. This means customers' price elasticity of demand has become relatively high for non-staple and luxury items. This cuts into revenues of supermarkets because consumers will always look for cheaper alternatives or reduce consumption. The numbers in yellow indicate products with more elastic demand. Based on all of this, I recommend the purchase of Woolworths shares for numerous reasons. The stock pays out a consistent dividend, so the passive income is attractive, and the price has a strong history with a tight 52-week period indicating low volatility and a safer investment. Woolworths is taking full advantage of the emerging online market, having quickly added infrastructure and are currently ahead of Coles in terms of consumer sentiment and sales. This points to a positive outlook for the company and investors. However, Woolworths shares are relatively high at $37, meaning many small investors will be priced out. Moreover, the price war with Coles is beginning to ramp up, with Woolworths locking prices of 400 items, which cuts into profits and could be of some concern for potential investors. Ultimately, the outlook and health of the company is too positive to ignore, and it is simply too big to fail. Meaning even if Woolworths experiences a downturn, investors will still be able to recoup some of their investment, making this a safe and lucrative stock option. So here are my references. Thanks for listening.